A nation's most powerful men lost everything, not to war but to a spreadsheet. In the year 1720, the British elite, from esteemed members of parliament to revered scientists and even the royal family itself, found themselves entangled in a financial web of their own making. This wasn't a foreign invasion or a natural disaster. It was an economic catastrophe born from unchecked ambition and a collective delusion. At the heart of this storm lay the South Sea Company, chartered in 1711. Its initial premise was deceptively simple: to trade with Spanish South America, a venture promising immense riches from exotic goods and a lucrative monopoly. Yet, the reality of this trade would prove far more complex and ultimately far less profitable. The company's true value, however, wasn't in its cargo, but in its audacious proposal to the British government. Britain was burdened by a massive national debt, largely accumulated from costly wars. The South Sea Company offered a solution: absorb this debt in exchange for exclusive trading rights and an annual interest payment. This wasn't a small offer. We're talking about roughly £31 million, a staggering sum for the time, equivalent to billions in modern currency. The government, desperate for a way out of its financial quagmire, saw this as a lifeline, a chance to stabilize the nation's finances and restore confidence. The scheme was approved, and the South Sea Company began exchanging government annuities for its own shares. The initial promise of a stable investment, backed by a government eager to reduce its debt, drew in investors. But the real frenzy began when the company's directors started inflating expectations. They painted vivid pictures of untold riches from the South American trade, despite the harsh reality of limited access to Spanish colonial markets. Rumors of vast gold mines and lucrative plantations, though largely baseless, fueled public imagination and ignited a speculative fire. The share price, which began the year 1720 at around £128, began a meteoric ascent. By March, it had reached £330, by May, £550, and by June it peaked at an astounding £1050. Fortunes were being made on paper almost daily, creating an intoxicating environment of easy money. This rapid appreciation wasn't based on any fundamental improvement in the company's actual trading prospects. It was driven by pure speculation, by the belief that prices would continue to rise indefinitely, drawing in more and more investors hoping to get rich quick. The South Sea bubble wasn't alone. Its success spawned a multitude of copycat ventures, known as bubble companies. These were often absurd, with names like a company for carrying on an undertaking of great advantage, but nobody to know what it is. This era saw an explosion of speculative schemes: companies for importing walnut trees from Virginia, for making oil from sunflowers, and even one for a perpetual motion machine. It was a carnival of capitalism, where logic and due diligence were swept aside by the allure of instant wealth. The government, initially benefiting from the South Sea Company's ability to absorb debt, eventually grew concerned about these proliferating bubble companies. They passed the Bubble Act in June 1720, making it illegal to form joint stock companies without a royal charter, effectively targeting these new, unregulated ventures. Ironically, this act, intended to curb speculation, backfired spectacularly. By validating the South Sea Company's chartered status while suppressing its competitors, it funneled even more money and investor confidence into the already inflated South Sea shares. The peak was short-lived. By late summer, cracks began to show. Savvy investors, sensing the unsustainability of the price, started to sell their shares, locking in their massive profits. This created a ripple, then a torrent. The decline was as rapid and brutal as the ascent. By September, the share price had plummeted to £150. By December, it was back to its starting point of £128. For those who hadn't sold, the paper fortunes evaporated, leaving behind a trail of ruin. The consequences were catastrophic. Thousands of individuals, from the highest echelons of society to the aspiring middle class, saw their life savings, their inheritances, and their dreams vanish overnight. The economic shockwave reverberated across Britain. Members of Parliament, wealthy merchants, even the king's mistresses were implicated. Sir Isaac Newton, the brilliant physicist, lost £20,000, lamenting, "I can calculate the motions of heavenly bodies, but not the madness of people." The fallout extended beyond individual bankruptcies. Public trust in financial institutions was severely eroded. The government itself faced a crisis of confidence, having endorsed a company that ultimately brought so much suffering. Investigations followed, revealing widespread corruption among the South Sea Company's directors and even some government officials. Bribery, insider trading, and fraudulent accounting were uncovered, painting a grim picture of systemic deceit. Several directors were arrested, their estates confiscated to compensate the victims, though it was a mere fraction of the losses. Some even attempted to flee the country, only to be caught and brought back to face justice. The South Sea Bubble serves as a stark historical precedent for financial bubbles. It demonstrated how irrational exuberance, fueled by speculative greed and a lack of transparency, can inflate assets far beyond their intrinsic value. The lessons learned from this disaster eventually led to greater regulation of financial markets and a more cautious approach to public debt management. It highlighted the critical need for investor protection and accountability in corporate governance. Centuries later, the South Sea Bubble remains a powerful cautionary tale. It underscores the enduring human tendency towards herd mentality and the perils of believing that this time is different when faced with unprecedented market gains. The story of the South Sea Company isn't just about a stock market crash. It's about the fragility of trust, the corrupting influence of easy money, and the brutal reality that even the most educated and powerful can fall victim to collective delusion. It stands as a timeless reminder that while ambition can build empires, unchecked speculation can just as easily bring them crashing down. Explore another notorious chapter of financial history in our next deep dive.